Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi, everyone, and welcome to a new episode of the Capital Mind podcast. We're recording today's episodes just shortly after markets made a new all-time high and have, luckily for us, managed to stay as high or even trickled a bit higher since then. It's under this backdrop that we decided to bring in Deepak and ask him what he thinks of this new high in the markets, and also opine on, now that many of us are finally seeing our portfolios recover from the last year and a half, how does he view different types of investing strategies and what that means for how you make money through your investing strategy in the market? So, Deepak, welcome. And I think first thing is, you don't seem that awfully excited about that all-time high. You seem kind of relieved almost in that sense. And I think it pointed towards the fact that you said that strategies have different ways of making money, and now that you've reached this, it should inform how your different strategies should behave. So I think just to set the context, you had said there's arbitrage as one framework, then short-term trading or intraday trading, then long-term fundamental or fundamental-ish investing, then backtesting based, perhaps you could call it quant or semi-quant strategies, and finally privileged info and insider trading. Do you think you could talk us through these and sort of explain where we're at? Yeah.
Hey Shrey, thanks so much. I think this is an interesting point because all of us expect different things from markets. We have hit an all-time high just now, and one of the reasons I think even the market is not excited is because it's been coming for a while. We've been wanting, it's touched the all-time high in December 2022. We're at July 2023, and it's just about made about 2% since October 2021, which is nearly 2 years. So there is that fear or that thing that's saying, we should have gotten more 2-year returns of only 2%. Come on, Deepak, that's not exciting. This does make sense. I think it does make sense for someone who invested in October 2021 to say this. But I think, like you said, the expectation of the markets giving you exactly the same returns every year is wrongly placed. And that's why we were talking about the lumpy nature of stock market returns or the non-lumpy nature. Now, the non-lumpy is perhaps at one level, we should consider this called an arbitrage. So arbitrage is simply the simplest form of investments, which says I will buy something at one price and I will sell the same thing to somebody else for a different price. Now, you might say that is a business, a trade or something like that. But typically, somebody in the middle adds a value in that trade. When you don't add any value, you're just arbitraging. So, for instance, if I bought fish in Bangalore and I brought it to Bangalore, the price increases by 4x. But there's a value I've added. I've actually transported the fish. I have possibly taken the risk of some of the fish going bad. I have taken some of the risk that when I bought the fish in wholesale, that 50% of it was cut or not meaningfully useful to sell. So given all of those risks, my charging 4x in Bangalore makes sense, right? So I've added value in the process. But what if I told you that I went inside a market, picked up fish at 50 rupees, came outside, and all I did was walk outside, and I have a shop right on the outside. And to save people from walking all the way inside, I sell it at a 10% profit. That is arbitrage, really. It's just that it's giving you that extra thing. Now, think of this in the context of the stock market. It's like buying a stock in one place and selling it in another place at a higher price, which means I could buy on the BSE and sell it on the NSE. Now, earlier it used to be pit trading, right? So you used to have different pits. NSE was located in Bandra Kurla complex, BSE is in Dalal Street. So people in different areas, of course, NSE never had a pit. I think it was always electronic to begin with. But assume you had two different physical pits. The person who has the information of what is trading at what value in one pit and what is trading at another value in another pit can make an arbitrage and saying, listen, you want to buy at 100? I know I can get it at 99 in the other pit, so I'll sell it to you at 100 and I'll go buy it in the other pit at 99. So this is arbitrage. So when you buy the same thing at one place and sell it on the other place without adding meaningful amount of value, given that I'm saying that it's not meaningful amount of value. It's simply that the fact that if there's no value to be added, anybody can do it. It doesn't take a lot of brains to walk inside a market, pick up something and come out and sell it for something, right? So at best, your arbitrage is like the real estate space that you own. In the stock markets, there's no real estate either. So, there's no pit trading anymore of any meaningful sort. So you're effectively doing my screen versus your screen. Anybody who has a screen can do exactly what I was talking about, which is buy on the NSE, sell on the BSE, which is why the amount of arbitrage between the two is very little. It's very rare that you find that you can buy a large quantity on the BSE for a lower value than somebody wants to buy at the NSE. Because even the good buyers know that if I want to buy something, I can go to the BSE or the NSE and buy it. This is interesting because I think the idea of an arbitrager is that now I will make a small amount of money whenever there's an arbitrage because there's very little money to be made. So if I have to make only 10 paisa per trade, now you might look at it and say, dude, I don't want 10 paisa. But you know what? If an arbitrager does 1,000 trades at 10 paisa per trade per share, he makes 100 rupees per share. If he trades 100,000 shares, he can make 1 crore rupees. So he might be thinking, listen, I'll do 1,000 shares on one day to 2,000 shares on another day. I'll only make 10 paisa per share net after taxes and I'll make my money. Now, the idea about this is if initially people threw notes on the ground and allowed other people to pick them up, it does not take a lot of skill to do this. So you would find that 100 rupee notes get picked up very easily. And then over a long period of time, only like 10 paisa or 20 paisa coin remains. Now, we don't have 10 or 20 paisa coins anymore, but let's say 1 rupee coins remain. The number of people willing to make the effort to find a 1 rupee coin reduces. So there are only a few people looking for them. It doesn't take a lot of skill, but since there's so little to be made, it's only the person who puts the effort to find all of them or a meaningful amount of them over a period of time makes money. So arbitrage is a non-lumpy form of return. It is really, really non-lumpy in the sense that every single trade needs to make a little bit of money. But since you are buying and selling at exactly the same time, now, I'll give you the simplest form of arbitrage would be, of course, BSE and NSE would be one form of arbitrage. But there was a value add in there. What was happening was BSE would settle on one day and the stocks would come into your demat account the next day. And NSE, you were supposed to deliver stocks the next day itself. So if there was any glitch between the BSE and NSE in terms of the BSE not settling properly, then the trader was on the hawk for the difference. But now they've merged the settlements as well. So the risk is kind of gone. But let us say there was a stock and there's a future. The future trades at, say, 0.5% more than the stock. Now you're thinking, why would anybody bother? Because you have to buy the stock, you have to sell the future, and you have to make the 0.5% arbitrage between the two. Now, only if you buy the stock and sell the future do you make that perfect arbitrage, and you have to wait till the end of the month. If you get out sometime in the middle of the month, you may not make that arbitrage. So there is a time value for this arbitrage, and you have decided that this arbitrage can happen in the end of the month. How much will you make on such a trade? The answer to that has to be, listen, what's the risk-free rate? The risk-free rate is today 7%, maybe it's 6 sometime, maybe it's 8 sometime, maybe it's 4 sometime. You will make just about as much as the risk-free rate because A, anybody can do this arbitrage. B, for anybody else to borrow money to do this arbitrage, the lowest rate they can borrow at is the risk-free rate. So maximum you'll get is a little bit more than the risk-free rate. Right now, there is a problem in the market. Right now, this is July 2023. For the last 3 months, there has been a small problem in the market. The market has been bullish. And the bullishness has come from FIIs, and the FIIs come in and buy into futures first, and then they buy stocks. So when they do that, they push up the price of the futures. The stock price remains where it is. The spread between the two increases. So arbitrage funds make money. This is one of those times when arbitrage trades are making money.
So even arbitrage funds make money in this.
Arbitrage funds are making. In fact, I have an arbitrage fund which for the last 3 months is making 7.8%.
And risk-free currently is 6.5.
6.85.
Okay, so
liquid funds are making 6.85. So you're getting a 1% higher rate. But typically they range at much smaller. It's also dependent depends on liquidity. So sometimes liquidity is very high, so arbitrage does not yield as much returns. But what's interesting right now is that arbitrage is actually populated by very capital efficient people. So there are people for whom money is not, they don't have to borrow money. So they're using capital, whether it is mutual funds, which do not borrow, they just get money from investors. So for all their efforts, they're making about 7.5%. One part. Now think about this in a way. Almost every single trade is profitable. But at the same time, you don't have a lot of losing trades. And we'll come to this at a later point because we'll have to understand this carefully. You're winning most of the time and you're losing very, very, very little of the time. And why will you lose in an arbitrage? Let's say for whatever reason, some share, the stock price between the stock and the arbitrage future, the margin widens quite substantially. You end up with the exchange asking you for additional margins for every such opportunity, and then you're not able to pay those margins. So that is when a risk kind of happens. So that risk is very, very small. So I don't think you're going to factor that into as a major concern. So you're winning most of the time. I'll leave it there because we'll come back to this. Now, the next form of trading is from people who aren't exactly looking at a risk-free arbitrage, as in there's no risk in the arbitrage itself, but they're willing to take a little bit of risk. That little bit of risk could be, listen, I look at a stock chart and I'm going to take a directional bet intraday for 10 minutes. I just have to predict the next 10 minutes whether stock will go up or down. There are lots of charts I can look at. I've reasonably come to a point where I'm saying, listen, this is the time, this moving average has crossed over, I am going to get in. And I get in and out in 10 minutes. For such people, 1 hour is a long-term trade. So they literally get in and out in 10 or 15 minutes. Now, here is where you're going to lose a little bit. You're not going to win 100% of the time. But you may see that a lot of traders of this sort win 75-80% of the time. They do see a bunch of wins, but they cut their losses fairly early. The arbitrage trade on average makes a small amount. The intraday trade may make a bigger amount per trade. This is to compensate for the fact that you lose more. Now, the problem with both risk-free and arbitrage is that you're going to need to use leverage, because if you're going to make only 0.1 or 0.2% per trade, you don't necessarily want to make only 0.1%. So 0.1%, by the way, into 365, I mean not 365, but 200 days a year is 20%. It's quite well, is it 20% into 100?
No, I think you're right. Yeah.
You're right, yeah, correct. It's about 200 is 20%. But you're not going to make 0.1% every single day. You're going to make a little bit less than that because of costs and all that stuff. In intraday trading also, you might end up making, I remember we used to run an intraday system way back, and on a per trade basis, you would make 0.5% on average. That means some trades would make you 2.5%, some trades would make you minus 2%. So net, everything would make you 0.5% per trade and roughly 0.1 or 0.2% per day. That was the net profit you'd see, because you would take multiple trades. Sometimes your capital would not be fully deployed and so on. Now, in order for this to make me more returns, I would not actually trade this with all my capital. I would say, listen, I have 100 rupees. I'm going to go borrow another 500 rupees. So I'll take 600 rupees in total. That whole thing now, if I get 0.1% on my capital, I'm also getting that 0.1% on the additional capital that I borrow. I may borrow it at 10%. The differential, because I'm earning 20, I pay out 10 as interest. I get an additional 10%, which is a huge amount because my capital is much smaller. So I get a higher return on capital. This is very interesting because in India, the brokers themselves provide up to 4x leverage. So if you do intraday trading or futures trading for short term and all that stuff, the brokers provide futures, it goes up to 10x, and most of the intraday cash positions goes up to 4x. So which means, or 5x I think now, which means that for 100 rupees worth of trading, you need to have only 20 rupees worth of capital. So if you have 1,000 rupees worth of capital, you'll actually buy and sell 5,000 rupees worth of stocks intraday. Now you lever this up because the amount you make per trade is so little that unless it's levered up, it doesn't make any money. But importantly, you're going to go in and out so fast that your losses don't wipe out your capital. Very important to understand why this is. That's because while the number of trades is very, very large, because you'll do a large number of trades, you want to win enough when you win, so that it covers the fact that you lose certain amounts when you lose. So most of the intraday trading is that. Most. And I say this because roughly out of 100% of trading that's done every day, I think 30 to 40% or maybe 30-35% is intraday trading. Remaining 65% maybe delivery trading, where people get their stocks into the demat account. So for some stocks, 90% of the stocks volume every day is just intraday trading, and only 10% is speculative. Is actually delivery. Now, most of the derivatives trading is intraday, and options is almost all speculative trading itself completely. This is a different format. Now you've gone up the risk ladder, but you still are trading very, very, very frequently. You then have the part that we all love. We think that this is the Rakesh, the Warren Buffett. Buy stocks, do fundamental analysis, do this massive, you do the research and you come out with saying, dude, why hasn't everybody bought this stock already? This is the kind of fundamental investing we love, because this is the underdog investing, right? I bought this stock, nobody else was seeing it, and it's gone up 100x. So your deal is simple. If the stock falls, I'll lose 100%. If it goes up, I could make 500%. That's the simple thought process that drives long-term fundamental investing. And, like you said, I think we've had these discussions of all this. You can go do all of the meeting the management team and, seeing all the stocks. And then later, 10 years later, you can say, I bought Bajaj Finance. It went up 200 times. This is the core of, say, fundamental investing. Now, when you make money, you make so much money that it goes up 3x, 4x, 5x. I'm telling you, one of our stocks in the Capital Mind PMS portfolio, it was a stock that nobody was looking at because there was so little information about it. It was an offshoot of ABB, which was running their power grid division. It was called Power India. Now it's Hitachi Grid Power or something like that. I forget the actual name of it. But this stock has gone up 5x in 3 years. Now, when you have a stock that goes 5x in 3 years, if you have two other stocks that have lost all their money, you're still okay, because net you've still made a reasonable amount of money. But I'm not going to do this. I'm not going to find 100 such positions. There is no way. Nobody can find such per day. I'm not even going to find 100 per year. So probably you'll have 20, maybe 40 positions in a year. So at any given point, you can have a 50% win rate, which means my 50% of my positions are making money, 50% are losing money. But I'll still net make money, because when I win the 2x, 3x. When I lose the 70, 80% at max, right? So sometime you're holding for the long term, and that's when the 3x and 4x happen. The 3x and 4x happen just very naturally. To give you the simplest example, the Nifty is at 22 times earnings today. It was at 22 times earnings possibly in 2016 as well. And 2016, it was at roughly half the price it is now. Is the fact that the earnings have gone up, have taken the Nifty value to double in about 6 or 7 years. And that is simply, so that is the way the system works, is that your valuations will go up over time as earnings increase, but at the same time, because the Nifty earnings have doubled, you would expect that the stock that is kind of mimicking the Nifty would have doubled in price. That's a 2x return right there, right? If it continue to maintain the same P. So you're holding for the long term, you tend to get these 2x, 3x, 5x returns in the winners. And if you can control the amount you have lost in the losers, then you are starting to make money. Now, getting to a structure here of how we're thinking of trade, but think about this from the aspect of Nifty's returns in the last 7 years were not an even 10%, 11% per year. We've seen them come, but most of the returns in the last 7 years have come from 2020 and perhaps 2021 and maybe a little bit of 2017. That's about how the returns have been stretched. It's not all at the same time. Your stock, which went up 2x, didn't go up 2x like saying, oh, it's 2x, it means 100% return in 10 months, so it's 10% per month. No, it didn't. It did nothing for a few months and then 100% in like 2-3 months. I'm going to leave this here because we're going to come back to it. But that's the lumpy nature of stock market. And this is even more evident if you get into the next phase, which is the backtesting based investing. Now, I personally, let's just give an example. I like the concept, and I keep talking, let's say a lot of people keep talking about it. I like high return on equity companies. Fine, you like high return on equity companies. How do you test that high return of equity means high returns to a market overall? Now, as a tech guy, I will say, listen, tell me what you mean by high return on equity. It's quantified. Oh, well, Deepak, I will do 20%. 20% return on equity is fantastic because that means the company has money, it has a good net worth. If it's not getting 20% on the net worth every year compounded, it's a waste of time. So I would rather buy businesses which have only 20%. Is that all? No. They should also not have too much debt. Well, what is too much? Quantify. Okay, debt to equity should be less than, say, 0.75. Okay, fine. Debt should be less than 75% of equity of net worth. I'm fine with that. I can put these into formulas. I can take all the stock prices in the last 20 years and say, listen, get me companies that with this formula I would have bought if I had started buying in 2005. Now, don't give me the concept that's saying, oh, you know what, JP Associates came, but you know what, JP Associates is a fraud, so I won't buy it, or JP Associates is not working out. So you can't give me that as a reasoning. If it looked like it had high ROE in 2005, I have to buy it. So you put this together and you say, well, I'm going to test. I was in 2005. I had no knowledge of the future. I decided to run a formula and I said, I bought these list of stocks. I'm going to buy them. Then I'm going to rerun the formula after, say, a year. And I'm going to say, oh, you know what? JP Associates, which came last time, is gone. Something else has come in. It's Titan. So I'm going to buy Titan. Whether Titan qualifies because, I like the Tatas or not has no relevance anymore. It's only one thing. It's just that. So you get this and you take these quantified measures. It could be anything, low P, high P, quantify it. What does low mean? What does high mean? And we'll buy it. Find a rebalance frequency. So once a year, we change things. And you run the test that says, well, you know what? If I had done this from then to now, would I have beaten the Nifty if I had taken the same position in the Nifty rather than whatever this strategy is? This backtested quantitative investing is a very different beast. Here's where you can get a lot of parameters. Do I make money on every trade? Do I make money on some trades? Do I make lots of money on some other trades and so on? And almost every hedge fund, every VC fund will have some idea of such metrics. And hedge funds in the world will always have, a lot of hedge funds have quantitative strategies that simply run in order to meet your overall metric of saying I need to make net returns for the customer. Backtested quantitative system is very varied. If you can backtest an arbitrage strategy, for instance, you can backtest a long-term fundamental strategy, you can backtest a pure price-based technical strategy. I think given all of these parameters, you are forming a different view. There's no more subjectivity, it's only objectivity. You have to be objective about everything because you can't backtest subjectivity. So that's another form. And the last bit is where you have insider trading. Now, I play golf with somebody and he's a CEO of a company and he tells me something and I say, okay, well, you know what? I should go buy this stock. Now, some of this is illegal. Some of this cannot be said, you shouldn't be doing this. But what if you, for instance, saw your neighbor who's a CFO of a company suddenly start to upgrade his car, build fancier stuff? Now, there are only two reasons. One is he's getting a higher salary. And if you think the company is clean, is getting a higher salary, that means the company is making money and, buy the stock. Is that insider trading? Answers no. It's just privileged information because you are privileged enough to be his neighbor and I am not. So you have that much more information. You may be a supplier to the company. You're supplying to the company comes and says, I want to double my orders. And you're like, dude, what's happening? He says, no, just double my orders. Just don't ask me why. I'll pay you the money. And then suddenly you look at this and company says, if they're doubling their orders, they must be doing well. Let me go and buy some stock. Of course, this you can qualify as, this is unpublished price sensitive information. But you know what? I'm a supplier. I don't have any idea of whether it's price sensitive, why they're buying more and whether it's sustainable. As long as I am buying more, I'm buying more. Now, this is not everybody can do this. Because now this is where the khabar concept comes up. Do you have khabar about this stock? So that's the kind of stuff. Now, the problem with the whole market is, now I've explained all of this, people expect when I say stock markets to say 10%, 11%, 12%, they expect this entire thing to be like linear. And I think that becomes a big problem in the stock market specifically. It's not so much in every other place. I think expectations of a linear return are only possible in the first few strategies that we talked about.
Maybe only the first one, maybe only the arbitrage.
Maybe only the arbitrage. But everywhere else, returns happen to be lumpy. The lumpiness of stock returns or non-returns is where, there's a, focus of our conversation. And one of the things that actually is very interesting is that we keep thinking the right money should be made in long-term investing. But guess what? Warren Buffett had a huge long-term position on Coca-Cola or Amex. Rakesh Jhunjhunwala had a huge long-term position on Titan or Escorts. But they also made a large amount of money in really short-term trades. Buffett's average holding period was 6 months because he takes a lot of positions which are merger arbitrage, where he bets on 3-month and 6-month moves. Rakesh Jhunjhunwala is a very famous short-term trader, and he keeps saying that I'm generating a lot of capital using my short-term trading. This is not something that I would advise you guys to do, but I'll talk about long-term trades. I don't think this has necessarily been a bad thing because they both understand stock market returns are lumpy in nature. And, while Buffett had these ARB positions, he's not going to come and tell you guys also do this ARB. What they'll want people to emulate is simply the fact that you can take a position on a company and stick for it for a long time. There are different reasons to buy arbitrage positions, different reasons to buy this thing in long-term positions. But the difference is Buffett's awareness that this is a short-term trade and that is a long-term trade is very clear. I think so is Rakesh Jhunjhunwala. He'll never say, I got into a Titan, I put so much capital into it, but next month I'll get out. Oh no, it fell. Let me become a long-term investor. This is the typical, Indian long-term investor comes by being a short-term investor and failing, which is unfortunately. But that's where we are. And here's where I think we should introduce a concept, say called expectancy. Now, the word expectancy has a statistical meaning. Now, if I do 5,000 trades and I make 500%, now 5,000 trades over many years and then I make 500% in total, the average per trade is like 0.1%. Now, I could make this in many ways. I could make 0% on it on 4,999 trades. And that one trade gives me the 5,000%, which means I get a 50x on one stock and I lose all my money on the remaining. Or I could do 0.11% on all my winners, 0.09% on all my losers, and win like 51% of the time. Just that is enough to make 0.1% roughly or this thing or that. So now think about, I'll go back into the arbitrage part of it. Think of the arbitrage as a bit like an FD. You don't lose money. Why do you lose money? When the bank shuts down. If the bank shuts down is the only time you lose money, every other time your everyday value of the FD is only going up. So 100 becomes 120 in 20 days. You're thinking it becomes 101 in the first day, 102 in the next day and so on. So it's like a straight line graph you can call it. It never goes down. There's no volatility in that at all. But what if it's a cooperative bank that shut down? Oh, wait. It went up 10 days and then went down to 0. Forget 10% return. It's now minus 100%. So this doesn't happen often because the banking system is robust and all that stuff. So you don't lose money in banks in general. But 1 out of 100 times, you're going to lose money. Now, 1 out of 100 times when you make an FD, maybe not in the biggest banks, but I'm just saying, if you did 100 different FDs with 100 different institutions, one of them is likely to fail. Now, what would you do? You would say, well, you know what? I will put some money in 100 banks. Now, in those 100 banks, I get 6%. So, if out of 100, only one fails, 99% of them, so I put 100 rupees now, 1 rupee per FD, or if you want, because we'll discuss big numbers because there's no risk in this discussion, why not? Yeah. So, if we have 100 crores, we put 1 crore in each FD in 100 banks. And then one of them failed. 99 succeeded. So 99 crores becomes with 6%, 105. right? And the one that you lost is 0. So your 100 crores became 105 crores. So although you got 6% on most of your FDs, that one loss brings down your overall return to 5% because 105 on 100 is 5. So your return has come down. This is your expectancy is effectively 5% on a per trade basis. How much have you earned? Your per trade basis, you earned 6% on 99 crores, 99 different trades you earned 6%. One you earned minus 100%, which effectively comes down to 5% per stock, per bank FD, right? This is interesting. However, what if I change this a little bit? 10% of your banks, because they were cooperative banks and you just blindly put it into everything, 10% of your banks.
Or you were in US regional banks or something.
Or you use regional banks and it's possible that they completely fail or lose your money. 10% of your stocks go to 0. This 100 crores, 90 crores has given you back money. 90 crores into 1.06, which is 6% increase, is 95.4 rupees, 95.4 crores. You're thinking, okay, 95.4 crores there. But the remaining 10 is completely gone. So what you invested as 100 has now become 95.4, effectively losing you about 4.5%. So your expectancy is negative. Negative 4.5% on 100 trades is minus 0.45% per trade. This is that correct?
Yeah, you're
minus
right.
0.045% per trade, but still, it's interesting because not because of the magnitude. It's just because it's a negative number, you shouldn't do it. So anywhere where you have a 10% chance of losing, you need a higher return. Now, how much return would you need? I think you would need something of the order of, 11 or 12% to just break even. That means if my 100 needs to remain 100, on the 90 that win, I need to make 11% because the 90 that win go from 90 to 100. And the amount I lose is 100%. So I make 0%. It's a break even, right? So this is zero expectancy. So if I want a little bit higher expectancy, then I should obviously increase the amount of how much I win when I win, just because I have a 90% win, 10% loss ratio. Now, your win-loss ratio is 90 to 10, but the odds are plus 6% when I win, minus 100% when I lose. This is terrible. This is horrible odds. It's an inverse lottery ticket. In a lottery ticket, there is a very small chance of winning, but you win a huge amount. You lose most of your money, all of your investment every single time. But lotteries are by definition negative expectancy trades. They are just luck when you win. Because the negative expectancy is simple. Somebody has to make money running the lottery. They're going to take away that part of the winners. And therefore, the negative expectancy applies to you in a very big way. Now, this is where, it's interesting because in a lottery, if you keep playing the lottery, there will be one time you'll win. At some point. Maybe it's 95 by the time you do it. But you'll win at some point. It's a little bit of money. You look at your wins and you say, Deepak, I played for 20 years and this year I finally won. It wasn't a result of effort. It was the fact that the nature of the investment or the thought process was lumpy. It is supposed to win you only 1% of the time or less than 1% of the time. Otherwise, it wouldn't be an investment. It wouldn't be even a strategy. Whereas in an arbitrage or in an FD, you'll never tell me that. You'll be like, I'm winning every day. Until one day you lose. So the lumpy nature goes towards the loss, not towards the profit. So I think, this is where it gets interesting because in an arbitrage, you're going to lever yourself up. Now, if I want an arbitrage, at best I'm making 2% a year, let us say, because the arbitrage is so tight. What do I do with 2% a year? I don't want 2% a year. I want 14% a year. So I borrow another 7 or 8% of my, or 7 or 8 times my capital. So I can do that, like say in the futures market, I can go up to 10 times my capital, make a small amount of money and it amplifies itself 7 or 8 times. So my 2% return actually becomes 14%. So, which is great because what happens over here is in the futures market, you can actually place as collateral, which is what is required to make futures trades, either a full cash component or 50% cash and 50% stocks. So you might have stocks you're holding for the long term. You use them as margin, so you don't have any extra cash that's going out from your pocket, and the remaining you can give a fixed deposit or a liquid fund or something as a collateral. This is great, but unfortunately sometimes things change. I'll give you an example. LTCM, one of the world's largest hedge funds, in 1996 to 98, I think that was when their life was. And there were two of the principals who even won the Nobel Prize. Now, what did they win the Nobel Prize in? Calculating stock options prices given a bunch of numbers. Now, they modeled their life thinking, well, you know what? Everything in the world is not going to break at exactly the same time. Nobody thought of it like that, but they said, well, you know what? Under normal circumstances, we should be fine. The problem was not the normal circumstance. The problem was the abnormal circumstance. And I'll tell you what they did. What they would do is buy something that said, I will buy something that is maturing, a bond that is maturing in 9.5 years because it trades at a lower value, and sell something that matures in 10 years. So the difference between them was only 6 months. I could afford to have that. So when we get closer and closer to the expiry date, I will actually see that whatever difference in price is come down to zero or close to zero. So if it was the difference in price was 10 rupees, it will come down to 2 rupees. I'll make the 8 rupees as a differential, and whenever that price comes down, this worked like a charm. And because they were making such tiny amounts, 10 rupees on, say, 5 lakh rupees of investment, they were like, dude, this is too little. We can't even, who's going to survive on this? So they levered themselves up even 100x. That is, if they had a lakh of rupees, they would put 1 crore of rupees worth of trade so that they would lever up the returns. This was fantastic. They made amazing returns with no volatility, because every time they announced their NAV, it was going up. Now, that's like a great Sharpe ratio, right? No standard deviation, because you don't have any deviation on the downside at all. And you have only upward facing returns. This is amazing. But then strangely, somewhere in the world, Russia defaults. When Russia defaults on its bonds, the spreads everywhere widened. So what was 9.5 and 10 ka difference was 10 rupees, now became 100 rupees. The differential 90 rupees, the bank said, listen, you have to place, this is your mark-to-market loss, please give us the capital for this. These guys are like, dude, we levered up 100x, are you out of your mind? I don't have that kind of capital. They said, well, you're gone. And when they say you're gone, the whole world could have come crashing down. The Fed has to elaborately organize a private sector rescue. This coordinated by the Fed, and eventually LTCM was taken over by these banks and all of that stuff. It was a bailout. It was not that LTCM was doing something bad, because in the end, a lot of the money was recovered because those arbitrage spread widenings reduced over a period of time, and then got people back some, or if not all of the money. LTM was fantastic until it was not. Fantastic for a really long time, terrible for a really short time. That, well, and in a way, they still keep their Nobel Prizes. But the point was, it probably is a function of lack of understanding of how much volatility can exist in a market before you realize that the strategy is flawed. But think of this as the lumpy nature of stock arbitrage losses. You win most of the time, and you happily make a certain return. When you lose so badly that it wipes off everything that you've made. So it's a lumpy loss. Give you another example, and I think this is what's happening right now. There's something called 1 or 2 day expiry options. It's called 0 DTE or 1 DTE. DTE is days to expiry. You buy. So options inherently have a time value in them. There is, if something is a strike price of 500 and it's trading at 520, then the option of 500 strike price will not trade at 20 rupees. It will trade at 22 rupees. That 2 rupees is a time value. That time value goes lesser and lesser as you come closer to expiry. So if there's only 1 day left to expiry, this 2 rupees extra will go to zero within the next 24 hours or 48 hours. So you essentially try to bet on the fact that, listen, this 2 rupee decay will happen in a rapid way, So what will happen is 2 rupees will go from 2 rupees to 1.5, then 1.5 to 1, and then go to 0. So you might get off sometime in the middle. People have been crazily trading this in India because now there is options expiry on Tuesday, something else expires on Wednesday, something else expires on Thursday, Sensex options expire on Friday. So there's every week there is something or the other that is getting expired almost every day of the week. This is huge in the US as well, except on one particular day, I think it was 2016 or 2017, when there was something called Volmageddon, which is, volatility is Armageddon. So the idea here is that there's a volatility index which trades the volatility. Now, if you wanted to benefit with this, going short option, selling an option and then buying it back when the time value is much lower, you're actually going short volatility. When you're going short volatility, you're trying to get time decay in your favor and buying. Now, there was an index which actually traded this. It was called the inverse VIX. The inverse VIX is the inverse of the volatility index. So if you were long the inverse VIX, you are effectively short the VIX, and therefore you are making money on this time decay. They made money over lots and lots and lots of times, except when one day volatility shot through the roof. It went so far up that those ETFs went to zero. Not because they were so heavily, they effectively were writing options. Options are inherently levered. So they went to zero in a single day. So I don't know if that will happen in India. But let's give you a wild example of what could happen. And this is probably the only reason why an option trader might end up losing money. This is a lumpy nature of problems because you wouldn't have seen it so far. Suddenly one day it will turn up. Say there's a 19,000 is where the Nifty is at. It's a little bit higher than that today, but give you a round figure, 19,000. Now you're thinking, listen, it's at 19,000 today. By tomorrow it won't go to 19,100 plus, or it won't go down to 18,900 plus, which is 0.5%, and Nifty doesn't do 0.5%. So maybe that is your assumption. So you sell these options at 10 rupees each. The 19,100 call option, the 18,900 put option. What this does is gives you 20 rupees. You can take home this 20 rupees if the Nifty does not go beyond either barrier. What if it does? You're thinking, dude, it has to go up 100 points, then plus the 20 that I've earned, 120 in total, for me to lose money. So if it goes beyond 100, at 105 I will sell. So if it goes from 19,000 to 19,105, I will sell. Or 18,895, I will sell. So I don't lose too much. Maybe, at that time, what is 20 rupees today together added up is probably 23 rupees. So I'll lose 3 rupees on this trade. Fine with that. Everything's fine in a continuous world. So the problem when I say the word continuous, I mean, we don't think of the fact that markets are by nature discontinuous. What does that mean? There could be days in which the market hits a lower circuit. When it hits a lower circuit or an upper circuit, it no longer trades. You could go from 19,000 to 21,000 in one stroke without a continuous nature of it, the whole thing. It could literally happen over a few seconds. You won't even be able to react and the game is over. Now, what happens when you do this is that, let us say it goes from 19,000 to 21,000. Just to give you an example, that's 2,000 points, right? And your trade, which required only about, say, 2 lakh rupees to put together for 50 times 15 Nifty. So you were going to make maybe 15 to 20 is about 1,000 rupees on this trade. And in your mind, it was, I'm making 1,000 rupees. I'm putting 2 lakh rupees of capital. I'm making 0.5%. Except when the Nifty goes up 2,000 points, you lose 2,000 into 50. That's 1 lakh rupees. So you lose 1 lakh rupees on that one single move. And guess what? The Nifty has circuited. There is no more trading. The markets close and then they wait for it to come back up after an hour. And then there's another circuit at 15%. Let's say it hits that also instantly. You don't have any chance of even having put a trade. It's happened in a flash. It's gone. And this, guess what? This has happened not once, not twice, but many times. But the upper circuit has happened once. It went to 10% plus, then 15% plus, and then 20% plus. So your losses may not even stop at 1 lakh. It can go to 1.5 or 2 lakhs. You had only 2 lakhs to begin with. you lost 100% of your capital in one trade when you were making 0.5% of your capital in a bunch of other trades. This is amazing, but this happens all the time. This is, a discontinuous jump. It's, you could make your century scoring singles, or you could make it scoring after you're at 97, like Sehwag would normally do, just go and hit a 6. So the score 100 never turns up. You never hit 100. You just went from 97 straight to 103. It's a discontinuous jump in a way. We keep thinking stocks will go up one little bit, but the hedge that you might have set up, it won't even kick in, because for a hedge to set up, what needs to happen is your price needs to be hit, and a trigger will be sent to your trade that said, well, you know what, since this price hasn't been hit, we need to place a stop loss order. By the time your stop loss order has come in, the price has gone somewhere else completely. Because prices go up so violently is why the NSE actually banned some kind of stop loss orders. They're called market stop losses, where they say that, listen, give me a market order. That means take whatever price is in the market whenever my stop loss prices hit. The problem with this is, if it hits at 105, your stop loss order may actually execute at 175. You didn't know why, but you put a market order. Like you, there were hundreds of the people who placed a market order. The price just kept going, and then next time it's back to 110. Now you're thinking, the broker has screwed me. The broker has made my life miserable because he made a trade executed at 175, but it was the nature of the loss. It was the markets are inherently discontinuous at extremes. So this is another example of where your expectancy has to account for the fact that once in a while you're going to get this enormous loss. So if your expectancy is positive after this enormous loss is when you make money, right? I think this kind of covers the arbitrage end of things. But we have to, I guess, also look at people who are the other extreme, who don't win most of the time, like a lottery ticket. But not like a lottery ticket, because we've got to give them fancier names. So in a way, let's say the example is the VC world, the venture capital world. Now, here's I think the rough thing. And I know most VCs know this, most people in the game know this, but people keep asking, and perhaps even I was one of the people who asked, why doesn't the VC invest in my company when I can easily, my company's valuation can go up 2x in the next 7 years or next 5 years? Or maybe 3x in the next 5 years. Why? Who wouldn't want a 3x return in 5 years? The answer is the VC is the exact person who does not. And I'll tell you why. The economics works in a completely different way. So let's say you raised $100 million as a VC. Now you're thinking, listen, I got to invest this money. And how much do I need to make? Now, for a person who's investing in you as an LP, a limited partner, they would say, listen, Deepak, if you take my 100 million, I need to get 14% IRR. 14% IRR means double my money every 5 years. I'm giving you the money for 10 years, so you have to make it 4 times. So 100 million needs to become 400 million. I am now thinking 100 million becomes 400 million. 100 million, I want to charge 2% a year as my management fee. So because it's going to cost me to travel and meet companies and all that stuff. That's 2% into 10 years. $20 million is gone just like that. 20 million, I have only 80 million. Now 80 million has to become 400 million. I know that the VC space is very, very weird. I'm investing in really early stage companies. They have to grow. They may not grow. I know that they're going to be. But typical funda is out of my 20 companies that I invest in, which I'll put 4 million per company because I have 80 million. So I put 4 million per company, 20 companies. I know 10 of them will go bust. They will not be able to make it. So I lose the entirety of that amount of money I've invested with them. 40 million is gone.
You've got 40 million left, you have to make 400. Yeah.
40 million, you have to make 400. But of the remaining, it's not like each one of them is fantastic. 8 of the remaining are just about going to give you your money back. Some of them will go positive, some are going to get negative, but net you'll just get your money back. So you're getting 32 million back on 8 companies. Now you've invested 100. You can't go back to your investors and say, boss, I've got only 32 million to show for it. The remaining 2 companies, what do they need to do? They need to give you $368 million. That means from their 4 million that you invested in each of them, they need to give you nearly 100x return. So if they go in and they will not be able to identify which of their 20 will give them the 100x return. They just need to go in thinking every single of my companies has the capability of giving me 100x return. Otherwise, I'm not bothered investing in them. This is the early stage VC's problem. So the more the number of companies they invest in, they have to see the 100x, they have to see the 50x plus kind of returns in order to make just the 14% CAGR that is slightly above what capital markets make. Otherwise, capital markets make like 12% in the public markets, right? So you want to see this. So if you say, I'll double your money in 4 years, they're like,
18%, but that doesn't do it for them, basically.
basically for them, they want to see you as saying, listen, can you take my 100 and make it 5,000? If you're not there, it's not like they don't like you. It's just that they don't like you enough. Yeah, this is, I think, the rough, overall structure.
So that you've covered both extremes, and you've covered the, let's call it the arbitrage and how that works, and of course the more probabilistic or big bets VC model. The quant models, which we use very often, I think they're not as extreme. They're somewhere in between both of these, right? In that way.
Yeah, because you see, a VC can't chop his losses. He has no liquidity. You can't come and tell me buy Byju's or buy something today, because
no one will, perhaps.
Yeah, because once it's losing, nobody wants to hold it.
Or you'll buy it at some horrible discount, which is
which is like in some cases we've seen now 90% discount and so on. But here's my interesting point. In a public market, you have the ability to get out at 30% loss. Now, there's a very interesting way to kind of put this. If you limit your losses to say 30%, so you get out when there's a 30% loss. And when you win, so that means if I put 100 rupees in a stock, I will get 70% out of it. Forget 30%, let's say 50%. Even in 50% loss, you'll get 50 rupees back. And I run the same strategy, but I can't run it like a VC. In a VC, I have 2 extremely big wins, 8 evens, and 10 complete write-offs, right? I would just say, listen, if I have a 55% win ratio, just a 55% win ratio, that means out of 55 trades that I make some money, and 45, I lose some money. In the 45, I lose 30% or 50% per trade. In the ones that I win, I make 2x. So I make 100% on the winners. So if I did that, just doing that is a very good positive expectancy strategy. And within the winners, all the winners won't be the same. If you look at the Nifty over the last 10 years, the Nifty over the last 10 years actually has a very interesting characteristic. Less than 5 or 6 stocks will actually make you more than 20% returns per year. Everything else will give you suboptimal, sub-inflation, or deeply negative returns over a 10-year period, simply because that's the nature of markets. It's concentrated in a few stocks, and it's concentrated at a few times. I'll come to the times at a later return. But if you look at the stocks itself, you'll make your money in a few stocks. So similar to a VC, which makes most of its money in 1 or 2 of its investments, a stock market person will actually see most of its money being made in a few stocks. Now, if you sell those stocks early, without letting them give you the potential of those massive outsized returns, 2x, 2.5x, 3x, you are actually cutting off the only reason why you have a good expectancy, which is the great positive returns. So even if you have a 55% win rate, make sure when you win a lot more on average than you lose. Even the 100% per trade actually happens because one stock is giving you 600%, 2 or 3 stocks are giving you 25, 30%. So that the win rate over a long period of time depends entirely on your ability to hold your winners for a longer term. Also on timing. So I'll flip it another way. It's not just the stocks. It's the time. Certain years you will not make money. It's just given. This is the Nifty from its inception. This is most even the US stock market from their inception. If you take any 5-year cycle or a 3-year cycle, if you speak it, you're going to make crappy returns for 2 years. One really crappy return, one mediocre return perhaps, and then one fantastic year. Now, whether it was, like, look at the last 6 years. 2017 was fantastic returns. 2018 was So 19 was even lesser. I think, when 2018 was about 3% on the Nifty, 2019 was about 12%.
12%, yeah.
2020 saw a minus 40%. The stock market recovered to plus 4. So towards the end of the year. So it was a positive year, but it's still 4% is nothing to write home about. 2021 was fantastic. 2022 was ordinary. 2023 started off terribly. The first 3 months were lousy, but right now it's gone up to a 6% return, so it's looking quite interesting. So I think the nature of stock markets is to be lumpy in time. There will be 1 year when you make all your returns. If you get frustrated the year before that, or enter the year after it's reached it's gone and done its thing, there are very few times when you would have actually made money. So, for instance, in 2000 itself, when the dot-com bust happened, if you had exited in that year after the stock market went to an 80% minus, for 2 years you would have still seen a terrible return. It's into end of 2003 that suddenly your returns started to go crazy after that. So, and then 2004, 5, 6, 7, each of those years was blockbuster, was just amazing that way.
These are the Indian markets, of course.
These are the Indian markets, yeah. In fact, I think to some extent, the US markets are also similar, but nowhere close to the intensity or the fury of the Indian markets going up. I mean, it was so bad I had to write a ghazal in a post in 2007 saying, even I don't understand why markets are going up, but they're going up. And they're going up like they doubled in 6 months. This is as insane as it gets. And even in 1999, I think August to February 2000, the markets were up 110% or something like that. So it was some crazy number that I don't think we genuinely can get anywhere close to those kind of returns. Of course, not genuinely.
Who knows?
Can happen.
Yes,
Who knows? But I mean, those are indeed crazy years. But having said that, I think if you look at it from a time perspective, you're not going to make money every year. You got to make, there's this funda of time in the market versus timing in the market. And this is what it means. If you don't spend an entire evening at the beach, you will not get to see the sunset. So if the most beautiful part of the evening is the sunset and you walk away right before saying, bloody hell, the sun is never setting, it's easier to understand the sun will set because it almost definitely will set at a certain time every day. But what in the markets, there's just more uncertainty of whether it will come now or it will come 6 months later or it will come 1 year later. You just have to live through the bad times in order to get to the good times. And then the good times come, it almost feels like a blessing. Because that jab Bhagwan deta hai, chappat phad ke deta hai type thing is like a saying that says when you just get way too much than you deserve, which is perhaps where the structure is right now.
So I think that brings us very nicely back to full circle, which is where I started the whole episode, which is, so we've just hit this all-time high. Now, if you're okay with this, I'll embarrass you and ask you to make a prediction based on past data. We finally hit this all-time high after, as you said, what is it, almost since October 21 or something. Based on all these models we look at and all, how long can this good time potentially last? How big could it get? And one concluding question, you've mentioned all those different types of investment strategies. Which one is your favorite? Personally, don't even talk about Capital Mind. Which one is your favorite?
Got it. Okay. Let me go back to where what you can expect from here. This is actually quite interesting because if the last 2 years the markets have returned us only 2%, have they not earned any money, the companies that underlie the market? The answer is no, they have. They've gone up about 15 to 20% on earnings itself. So what was a 25 times earning multiple 2 years ago is now a 21 or 22 time earning multiple. That means the earnings have gone up about 15 to 20%. This actually means that effectively your underlying whatever you own is actually earning you more and more money, but you're paying the same price for it. In a way, it is not an all-time high for a PE. It's an all-time high for just the stock prices. Now, some parts of it is actually our anchor effect. We anchor ourselves to a lot of things. We anchor ourselves to the last high because it was Nifty was 19,000. How can it be 19,000? But you know what? Anchoring has created the wrong impression. Right now, for instance, to go to Bombay from Bangalore, or Delhi from Bangalore, ticket cost maybe 10,000 rupees today, even if you booked a day earlier. This is based on at least what I've seen recently. In 1992, my father used to go from Delhi to Bangalore and the tickets would cost 10,000 rupees. The market the earning capacity of every individual has gone up maybe 30x or 40x, and the cost of the price airline tickets are the same, which is why airlines make a lousy investment in general. But the point over here is that we've anchored ourselves to that 8 or 10,000 rupee price for the longest time. So when you hear that the tickets have gone to 25,000, you're almost like, how can they? But guess what? 25,000 from a 10,000 price 30 years ago is not a huge significant difference. In the same way, an all-time high now is not a significantly bigger number or a significantly big thing, because we've hit this number about 2 years ago. And 2 years of earnings have changed the fundamentals, right? So also, some part of it is expected. We have come all the way from, say, the earlier levels to now. What are the stocks that have given us the most returns? It is not the HDFC banks which have given us the great returns in the past. It's not the perhaps some of the companies that we admire in the FMCG space or something like that. It is companies like ITC, which did nothing for a longest time and suddenly got a wave of momentum that has pushed them into new all-time highs in the last 6 months. Smaller stocks in the defense sector, PSU banks, SBI for instance, and a bunch of others which if you asked me 2 years ago, are these stocks going to make us new highs? I'd be like, are you out of your mind? These stocks have not moved for decades. Things have changed. In a long time, you've seen that the fact that the stock market has made new highs after 2 years. It's that the lumpy nature of returns has ensured that a new set of stocks which have not made returns in the last 10 years have suddenly made returns in the last 2 years. Those are that's the lumpiness of it. And maybe you can call it mean reversion, but it's not really mean reversion. It's not that HDFC Bank has given negative returns. It's just that most of the big returns have come from other stocks. The lumpy nature of stock returns have meant that this all-time high is perhaps a little different, simply because new stocks are in. But every all-time high has had a different set of stocks driving it. In the US, it used to be ExxonMobil and Walmart in the 2000s, apart from the dot-com greats. In 2007, it was a bunch of other stocks, maybe a Cisco, maybe a bunch of others, maybe the subprime housing, financial services banks. And 2020 and 21, it was the tech companies that came and drove everything up. So there are new leaders to every market, and there are new leaders to the Indian market as well. So I don't feel entirely miserable about the all-time high. In fact, I feel it's a great time to invest. Recent studies, and that we've kind of found this, and Anup tweeted about this. The Nifty spends most time among all periods within 5% of its all-time high. That means 30% of the time we are less than 5% away from its all-time high. If I take every other bucket out, 5 to 10, 10 to 15 and all that stuff, I think only the next highest bucket is somewhere around 25%, which is more than 15% below its all-time high. So the Nifty itself has consistently been closer and closer to the all-time high. And this is the best part, if you were to just invest at all-time highs versus investing at all times or any other time and all that stuff, there's no major difference in the next 1 year or so. In terms of returns, there's no major difference even in 3 years on average. Though in a 3-year period, you've seen some times when and the Nifty has actually seen a negative return, a slightly higher amount than the others. But overall, on averages, you actually make more money when you invest in the market in the all-time highs. Now, I think when we started off this podcast, Reliance was stagnant. Had done nothing for years, for a couple of years at least. And on the same day as we're recording it, and perhaps it goes to say that, all lumpiness happens even when you're recording podcasts. Nifty's greatest return on the day we're recording this podcast is a plus 4% return in the Reliance stock, which keeps the Nifty up, and almost every other stock in the Nifty is down. So you've had even lumpiness in returns here itself. So I think even a value stock needs momentum at some point. You need those 5%, 10% moves in stocks consistently to give it returns. Secondly, I think if you're in a business where data matters, the data is actually telling us that all-time highs are actually great times to invest. for the most part. Now, I won't say every all-time high is a late time to invest, but look at where we are right now. It does not seem to be that all-time high where your neighbor is coming to your house and saying, sir, I want to borrow money from you because I want to invest in the stock market. This is how stock market bubbles are. Right now, most probably if you talk to your neighbor about stocks, he's going to be like, sorry, I have a fire in my kitchen. I'm going to go deal with it. Nobody wants to talk. It's a hated bull market in a way. While it's hated, it's fine. It's when it becomes too ebullient, with the word bull somewhere in there, though it's not pronounced. But it's where you have a problem. Now, and what I think the second part of your question, which is
Your
interesting.
favorite.
What is my favorite? Yeah. I personally feel that arbitrage and short-term trading are perfectly fine businesses to be, except I can no longer participate in any of that because they inherently need leverage, and as a PMS, you can't do leverage. We run a PMS, so therefore it makes more sense for us to not think of those strategies as useful. They're great prop strategies, proprietary capital strategies. They're just not great for larger amounts of capital, and they're not great for a fund manager in India to do. So, by nature, I think I straddle very well. I sit very well with the fundamental or quant based strategies. In fundamental, there's not that much of an advantage because a lot of it is special situations. I like the special situations kind of trade where I see a trigger and something is dramatically going to change. We have done this podcast on LIC where we expected profits to go up 7 or 8x. They actually went up 7 or 8x. Of course, the stock price has not gone up 7 or 8x, which is perhaps
Yet.
yes, yet. I hope that's the answer. But I'm okay with it because I'm like, okay, you have to give the market time, which over time I think will look better. But these special situations are attractive. But the most attractive part is the quant and fundamental piece, because I think over here, taking away the idea that a formula can be built, back tested, made to, you can observe it over a consistently long period of time. And inherently, I feel that prices are more trustable than most other things. If you add all of this up, I think the quantitative nature of the game, building into it a high expectancy. That means if I know that I can make over a period of time, I desire to make more than the Nifty, then I could backtest a quantitative strategy and figure out in what kind of conditions has it beaten the Nifty, has it consistently or inconsistently beaten the Nifty, what is the average per trade, how much do I make versus how much do I lose on a per trade basis, on a per year basis, on a per quarter basis. You can actually relive the emotions you might have gone through. Because if you see 4 or 5 continuous quarters of underperformance, you know that this is going to make you feel miserable. But I am willing to take a certain amount of misery myself. So I invest most of my money in the PMS. And here's where, the quantitative strategies like momentum have, and this is me personally, so I would not extrapolate it to everybody else. Over a 4-year period, it's given me a 20% annualized return, 20+% annualized return. And I have put money into it every single month. All my savings most of my savings end up going there. Not just momentum, but all the other strategies as well. So I find that to be one of the most attractive forms of investing. I find the special situations piece, which we have in another portfolio, and we're plugging our portfolios. I know, I'm sorry, but that this is our podcast, so we're doing it because we like to do it. But this, I think, is the special situations part and some of the fundamental changes that are happening in India, and betting on that long-term nature of some of the underpriced stocks in the market where I might not have too much in terms of backtest, because these stocks are listed like maybe 6 or 8 months ago. I don't have that much history to go with as well. But to bet on those actually form a smaller part of another portfolio. This, I think, the nature of the game is simply going to move to this level. The more important part is I need to be invested when the markets are going up. Because if I'm not invested when the markets are going up, and if the market goes up a tremendous amount from here, I miss the only alpha that is being generated in the portfolio, which is that when it goes up, you get higher returns. And when it goes down, you may not get, or you may get ordinary returns or just about as much as the market. You need the market on the upside to give you those higher returns. And I'll kind of go back and circle back to this. Why is investing exciting? I think one of the reasons why investing is exciting is because there is so much uncertainty, and you get bragging rights. People love bragging rights, right? So I invested 5 years ago and I did this and I did that. But you know what? The bragging rights over a period of time are just stories that you tell. You know, on average, hostel life is ordinary. But there are these great moments which you will remember for the rest of your life. Ask me to live 4 years in a hostel again, I will not do it. I mean, I'm old and I can't deal with all the complexities of not having water to, brush your teeth. But more importantly, I don't think I'd do that again, per se. But here is where the interesting, the change of thought process is that in markets too, on average, you will get a certain kind of return, but you will get some stories which just blow your mind all over the place. So I have to in my own head distance myself from this story part of the equation, which I like. I think it's exciting and all that stuff, from the returns part of the equation, which is clinical. And the idea of the being clinical is be long-term, be quantitative, be focused, and over time your returns will come. And you have to live through some of the bad times, and to be able for the good times to be able to come and come back to you. But more importantly, I understand that because they're lumpy, I know my win-loss ratio is probably going to be 50%. That means 50%, 51, maybe 52. So at best. But when I win, I want to make much more than how much I lose when I lose. If my investments take care of that, I think by and large you'll come out a winner in the long term. And if anybody else has different strategies, all you have to do is understand that the nature of your returns are lumpy in what direction. Are they lumpy in losses? Are they lumpy in profits? Are they lumpy in time? Are they lumpy in stock selection? If you understand that, I think happiness comes as a byproduct of that. But otherwise, you have only bitter stories, not the good stories.
Deepak, I think that's a lovely note to end on. And let's hope that this year is a pretty good one after the last 18 months. But thank you so much for that, Deepak. Much appreciated. So everyone, thank you so much for listening. If you've liked what we've had to say, have feedback, comments, questions, or just ideas for new episodes, just shoot them over to podcast@capitalmind.in. And if you want to read more about what we do and how we invest, visit capitalmind.in or capitalmindwealth.com. Thank you very much.